Good morning, everyone. Welcome to this webinar in our Dividend Heroes and Growth Giants series. Shortly, we'll be hearing from Julian Bishop, one of the managers of the Brunner Investment Trust. Brunner has a strong track record in both growth and dividend growth, currently trading on a discount of around 10.5%, which could be interesting. So the usual format is 25 to 30 minutes for the presentation, and I will put your questions to Julian at the end. Please do ask any questions in the Q&A box on the right. And with that, Julian, over to you.
Great, thank you. Thanks, Thomas, and hi everyone. Welcome. Thank you for taking the time to listen to me today. As Thomas said, I'm the co-lead manager of the Brunner Investment Trust. Just hoping I can see slides. At the moment, I can't. Sorry, Thomas, are you sharing the slides?
We can see the slides, Julian. Yeah. So we're on the
I can't. I can't, unfortunately. What slide are you on? Sorry.
First slide, but I can move any way you wish.
I can't see them. Oh, there you go. Okay.
Brunner in brief.
Yeah, okay. That's great. I can see them now. Thank you very much. Sorry about that, everyone. So we probably have a mix of people on the call who know the trust and people who don't. So just for those who don't, just a sort of brief introduction. So Brunner Investment Trust has been going since 1927 when Sir John Brunner sold a chemicals business. It was one of the businesses that came together to form ICI. And then the proceeds were taken and used to found the trust as an intergenerational family wealth vehicle. And the Brunner family still today own about 28% of the trust. So it's really run on that basis. So people who want to invest in equities, make money, not take stupid risks in a timeless way that will serve them no matter what the market conditions are. So it's an all-weather trust. Have a dual mandate focusing on growth in capital plus growth in dividends. And we do so by investing in a portfolio of global and UK equities. So we have a slightly unusual benchmark, but one which we like, which is 70% global, 30% UK. So a bit of a home bias. And I think that's terrific because certainly at the moment they're very, very different markets. So that benchmark split in itself brings a source of diversification, which we think is very appropriate at the moment. So the global market is very skewed to the United States. The United States is very skewed to technology, growth, sort of jam tomorrow type equities. Whereas the UK market, it's more mature, older economy businesses that aren't necessarily growing that much, but generate lots and lots of cash. So I think that's a useful sort of diversification in itself. We have a 53-year record of increasing the dividend every year, way ahead of inflation. So we think that's an important part of the proposition, that we provide an income that grows in real terms over time. So that's great. And we also, one of the features of investment trusts is you can build up a dividend reserve. So if for any reason the natural income for the portfolio of equities comes down, we can top that up and make sure that we continue that record of dividend increases. We won Investment Company of the Year in the global category last year, which we were really pleased by. Team of 4 of us, so 2 co-leads and 2 deputies, over 100 years of experience between us. So a sort of very tenured team, which brings a sort of variety of different perspectives to our investment approach. So next slide, please. So just move on from investment philosophy and team, maybe just to the next one. So that's the 4 of us, so me and Christian Schneider, co-leads, and Simon Gurgle, who also runs the Merchants Trust, which is a UK value trust, and James Ashworth as deputies as well. So next slide. So this slide just aims very, very briefly to sort of explain our approach. And really, in terms of investment philosophy, we want a balance. So we're an all-weather trust. And we want an approach which we think is timeless and flexible. So we try and balance quality factors, growth factors, and value factors. So we don't really think it makes sense to say that you are, for example, a growth manager and then pay no heed to valuation, for example, or be a quality manager and pay no heed to valuation. We think it makes sense to sort of balance all three of these factors. So what we tend to say is we have a strong preference for quality. We do think quality factors are important, but we also marry that with a determination not to overpay. And the result is a pretty eclectic portfolio of equity investments, ranging from some pretty strong, high-quality growth companies on the one hand, where we think the valuations are acceptable, to real cash cows at the other. So companies that aren't necessarily growing that much, but which deliver great cash returns. And then a sort of core of equities that are sort of somewhere in the middle. So equities that provide decent cash flow, but also grow. That's the sort of heart of the portfolio. And just to sort of delve into what we mean by each of these factors, with quality, we really are talking about companies that have unique capabilities, very strong market positions, sustainable competitive advantages. And the sort of financial outcome of those attributes is you tend to get good levels of profitability, so high returns on invested capital. We really like things like recurring revenue, so predictable income streams. So not sort of cyclical. We want companies that generate profits, rain or shine, if possible. Strong balance sheets. So even when we sort of delve into, what you would probably classically describe as sort of lower quality sectors, so areas like banks, real estate, companies where maybe there's a little bit more debt, a bit more leverage, where you're slightly dependent on external factors, we all tend to skew to what we deem to be the safer, stronger companies, the most resilient examples in each of those sectors, which means that generally in a downturn, you are better protected. So always thinking about sort of capital preservation as well as the opportunity to make money. Secular growth, ideally our companies will have structural tailwinds. Try and think pretty long term about this. Try and make sure that our companies are, perennially relevant. Try to avoid companies that are in structural decline, and we'll talk in a little bit about some companies where structural decline maybe is sort of creeping in, and we've changed a few things on the back of that. One thing that's very clear at the moment is that the digital world in particular, is changing a great deal because of the development of AI, and that has ramifications for certain businesses which now look as though their futures could be threatened. And then on value, we're looking at cash. So we're thinking about each of our equities as a cash flow stream. That's ultimately what underpins dividends. And we have just over 50 stocks in the portfolio. And if we look for 50 good cash streams that are growing over time, it's natural that the dividends will follow. So let's move on to the next slide, and perhaps this one here. Yeah. So if you think about some classic industry or company life cycle, companies are born, they grow, and then at some point they mature, and some businesses will eventually decline. And we're really trying to sort of center on businesses in the center of this process. So we're not about sort of emerging growth companies. So we're not about startups. We're not about sort of speculative concept stocks. Quite often these companies are loss-making. Occasionally they sort of break out and you get an incredible percentage return on your investment, but probabilistically that's not likely to occur. And statistically speaking, your odds of success are quite low. So we have a strict rule that we only invest in profitable businesses. And that applies to cash profits as well as accounting profits. And then we have some companies, sort of, up to 20%, probably about 20% at the moment, in the sort of rapid growth category. So these are proven businesses that are still growing nicely, and where we think the barriers to entry are really proven. And then at the other end of the spectrum, we try and avoid industries in a structural decline. So we don't have anything like tobacco. We've sold some more sort of delicate tech stocks recently, where we think AI perhaps is starting to threaten their long-term futures. So we've made a few cuts there because of that. But we're quite happy to have businesses which we think are mature, as long as they remain relevant, if they're throwing off lots of cash. So we have some examples of some businesses there. But the real core of the portfolio is in the middle. So steady growth companies not only generate cash, providing you with your return in that form, but also grow steadily. And if we go to the next slide, we'll see some examples of stocks that fit into each of these categories. So on the left, the sort of rapid growth side, we have some investments in some of the best tech businesses that are out there. So Microsoft, a good example of a company that's demonstrated exceptional growth over the long term and continues to be exceptionally well positioned. Alphabet, which is the parent company of Google, YouTube, recently sort of been a terrific equity, as I think people have realized that in the AI world, they're probably going to be a winner. And that's a stark contrast from where they were 6 months ago, when people were worried about what OpenAI and ChatGPT meant as a new source of competition. But they continue to grow very, very strongly. Got Taiwan Semi, TSMC. They manufacture chips on behalf of companies like NVIDIA, Broadcom. So all these sort of AI chip companies will all manufacture using Taiwan Semi. They have effectively a monopoly position in producing the most complex semiconductors on the planet. And then one of their key suppliers is ASML. This is a Dutch company that makes capital equipment to manufacture semiconductors. Again, an effective monopoly in their niche. And throughout all these companies, this is a sort of common theme. We like businesses which don't have competition. So a lot of our businesses are effectively monopolists, duopolists, have something unique about them, which means that they can earn superior returns and not be affected by the brutality of full competition. So that's on the left, and then there's some less well-known names there. So, for example, Monotaro is a Japanese industrial distributor. Baltic Classifieds Group, the best way to think about that is it's sort of like Auto Trader and a Rightmove, but it operates in the Baltic states. So sort of classifieds, again, pretty monopolistic position. So there's some examples in the sort of rapid growth categories. On the right, cash cows, so examples would be Bank of Ireland. So pretty plain vanilla bank, nice market structure in Ireland, 2 players, very strong position in deposits, mortgages, corporate lending. Bank of Ireland's, a real success story in terms of its economy. It's one of the few Western economies not to be really burdened with excessive debt. Actually has a balanced budget, unlike most of the West these days. And a company like that at the moment provides about 10% cash yield. About half comes back to you as a dividend, the rest is buybacks. They're basically getting 10% a year. And that continues, assuming that interest rates remain approximately where they are, and assuming that credit conditions remain good. In the energy sector, Total Energies, even with oil prices pretty low, they're still producing a cash yield of about 8 or 9%. Tesco, market leader in the UK grocery, really nice competitive position, much improved balance sheets. They have a cash yield of about sort of 6 or 7%. Clearly a very defensive business as well. Excuse me. So they're all relatively mature businesses, just generate lots of cash that comes back to us as shareholders. And then in the middle, just a whole gamut of sort of good quality growing businesses, which are sensibly valued and also provide a sort of decent amount of cash yield at the same time. So a variety of names here. So Visa, basically payments network, duopoly really with MasterCard. Exceptional market position, great network effects, which we'll talk about a little bit in a minute. And at a reasonable valuation, and throws off a decent amount of cash as well, and very good reasons why that company grows in most conditions. GE Aerospace, so this is the sort of remaining part of the old GE, which has been broken up. Jet engine business, amazing business, no new entrant in the jet engine business for 50 years since GE went in. The statistic is, out of all the flights that take off, commercial flights that take off worldwide, about 75% are powered by a GE jet engine. And it's a great business model because they sell the engines and then they get recurring revenues for the life of the engine, which is sort of 30 years plus, for spare parts and maintenance. So recurring revenues. And every year the global aircraft fleet tends to grow. There are huge backlogs at Airbus and Boeing. So the number of planes in the world continues to increase. And with it, so does their revenues. And their very strong market position affords them great pricing power too. So there's some examples of our holdings which hopefully sort of bring to life the proposition. Next slide, please. Mentioned sort of network effects there with Visa as a source of competitive advantage. There's just 3 examples here from around the world. Visa in the States, Autotrader, the classified website in the UK, and Brambles in Australia. And maybe go to the next slide and just has a little bit more detail about both. But network effects really are sort of a good example of the sustainable competitive advantages that we would look for. And really, the best way to think about a network is, it's like a phone network. If you think about a network of fax machines, you think about it, the first fax machine by itself was useless. But as more faxes machines are added to the network, it becomes an extraordinary tool and very, very useful. And these companies have effectively sort of the private ownership of networks of that type. So Visa, they issue credit cards. They don't manage the credit cards. That's done by the banks who also take the credit risk. They just issue the credit cards. And they take a small fee every time that credit card is used. And there are literally billions of Visa cards in circulation. And because everybody has a Visa credit card, every shop accepts them. So there's tens of millions of merchants around the world that accept a Visa credit card. And then there are tens of thousands of financial institutions, everyone from Lloyds to JP Morgan, who issue Visa cards and keeps this network alive. And it really makes it just very, very hard for new entrants to get a foothold. And their business model is every time somebody uses a credit card, they take a very, very small percentage fee. It's a very asset-light business. It doesn't take much capital to operate. So the profits for the business are exceptional. And as card usage goes up, as the volume of payments goes up, and part of that's inflation, just growth in consumer expenditure, more cross-border travel, etc. They grow. So a lovely business, we think, with decent cash yield, good growth, and great quality characteristics. Brambles, very unglamorous business. Basically, they operate networks of pallets, wooden pallets that goods are transported on, and it's the same sort of principle, really. You have a network of collection points and drop-off points for these pallets, and then if a manufacturer in Idaho wants to send some products to California, they'll be on these pallets, and the shipper pays to rent them. They just want the lowest cost, the most convenience, the most drop-off points, the most collection points. And once you have that network, it becomes very hard to compete with, because the economics of competing are just they just don't stack up. So a sort of nice business, stable, profitable, modest growth, but some growth, and overall a sort of unique business with very strong barriers to entry. And then Autotrader, most people in the UK have used Autotrader if they want to buy a second-hand car. Because everyone uses Autotrader, then every second-hand car dealer pays to list their inventory on the website. Very profitable business, very good pricing power. Shares have actually been a bit weak recently. There's a sort of perception, I think, that AI can somehow disrupt that business, which we would dispute, but time will tell. But we think because of that sort of marketplace, because of that very strong set of network effects, it's very unlikely that their position is dislodged. So that's one we're thinking about adding a little bit more to at the moment on weakness. I think if we go to slide 14, I think one thing that's useful for people to be aware of at the moment is that financial markets, and particularly in the States, are we think pretty frothy in some areas. There's a reasonable amount of press about this, so we're not alone in our thinking. But I think this sort of helps bring that sort of idea to life, that there is a sort of strong element of irrationality in financial markets at the moment, which means that I think you need a sort of sober voice to protect you from some of the risks that are out there. On the right, we show an example of the market cap of Tesla versus the market cap of Kia, the Korean car company, which is actually a Brunner holding. So the market value, so this is the sort of stock market ascribed value of Tesla is 1.4 trillion, which is 87 times that of Kia. And then we sort of point out, actually, last year Kia made more money. So there's just a huge sort of premium paid for these stocks with a story. Elon Musk sells a picture where the future of Tesla isn't just selling cars, it's selling robo-taxis, humanoid robots, etc. I mean, they've never sold a single one of either, and there's likely to be plentiful competition in those areas. So we're a little bit skeptical, to say the least. And so Tesla would be an example of a sort of company that we never say never, but would be very, very unlikely to buy. So very expensive, no cash, very, very little cash flow, and a narrative, a story. So it's all jammed far in the future that I think you'd probably be well served being skeptical about. On the left, there's another company called Palantir, which also gets a lot of press as being in the same sort of camp as Tesla or Bitcoin. So Palantir is actually a decent business. They sort of sell AI systems and solutions to governments. A lot of what they do is actually quite murky, but it has the same sort of meme type following. And their market cap now is 430 billion. And their revenue last year was just 3 billion. So, you're talking about well over 100 times revenues, let alone profits. Bear in mind that the valuation for the UK market, for example, is about 13 times profit. And here you've got 100 times revenues. And we just put this chart up to show the value of Palantir next to all the established defense contractors in the United States. So RTX, which is Raytheon, Lockheed Martin, General Dynamics, Northrop Grumman. Palantir is worth about 75% of all of those companies. You have 3 billion in revenues versus the almost 300 billion that they have. So, clearly a pretty extraordinary sort of valuation extreme, and the sort of thing that we won't participate in. If we just move on, we just also sort of point out some of the other stylistic things that have affected our 2025. So on the left, this shows the performance in light grey, so the line consistently declining since June 24. That shows the performance of effectively the quality factor over the last 18 months. So sort of persistent underperformance of the MSCI world. The chart in the middle shows more or less the same story, just in a different way. So the green line there, where the green line is going down, that shows quality stocks underperforming the market. So quality over the last 18 months are very much out of favor. But I take solace from the fact that the last time it underperformed to this extent was in 1999. So dot-com bubble, and then there was a very, very strong rebound in the following year. as the quality attributes of sort of resilience, safety, recurring revenues, high profitability sort of came back into favor after a very sharp period of underperformance too. Another thing to sort of point out as well is that income relative to MSCI World has had a very tough year. So obviously these stocks like Tesla and Palantir, they don't have much in the way of revenues, let alone profits. So there's no income, there's no cash yield with any of these stocks. So during this period as well, income has underperformed pretty measurably as well. So for Brunner, we've slightly suffered over the last 12 months in particular because of these stylistic headwinds, which means that so far in this year we're about 5% behind our benchmark, which not pleased with, but I think is reasonably easily explained by these stylistic headwinds. What this does mean is that these attributes are becoming relatively cheaper all the time. So income is becoming cheaper, quality is becoming cheaper. So I think the sort of setup into 26 looks pretty favourable in that respect. And then just quickly moving to slide 16. One thing I think to be aware of as well is that the market's becoming very concentrated. So I mentioned at the beginning that we like the sort of mix of global and UK. The chart on the left shows the concentration of the largest stocks in the S&P 500, so 500 biggest companies in America. And the top 10 names now account for 39% of the S&P. So the market's becoming very concentrated. So that's markedly more concentrated than the Brunner Investment Trust, for example. So most of those stocks are sort of tech stocks, which have done phenomenally well, great earnings growth as well, but increasingly they're sort of plugged into the AI narrative. So if you're buying the S&P, if you're buying a sort of US fund or a US tracker or a US fund which is closely mirrors the US index, you're implicitly taking a lot of tech risk. So what I would say is that the US market is becoming more like a pretty high octane tech fund than a little bit of everything, which is what you think about when you buy an index. And on the right, that just shows the chart of the Goldman Sachs non-profitable tech index. So this is unprofitable tech companies, which has just had this exceptional run over the last 12 months, which I think is indicative of everything we've been talking here. There is sort of a lot of froth in the market. A lot of that is associated with the theme of AI. And the next slide, we just show some stats about how much is being spent on artificial intelligence. This is obviously in the papers a lot and being talked about a lot and debated a lot, which I think is a good thing. But this shows the amount of capital that is being spent on AI infrastructure. So this is essentially data centers packed full of NVIDIA chips. And this is sort of based approximately on sort of consensus forecasts for companies like NVIDIA, and just sort of adding up what their expected revenues are expected to be. And the cumulative amount of money that's expected to be spent by 2030 is about $4.3 trillion. Now, by any stretch of the imagination, that's a vast amount of money. And on the right, it's quite small. What we try to show is that $4.3 trillion compares to, on the right, top right there, about $900 billion. So it's about 5 times the amount of money spent, about $900 billion, which is all the money ever spent to create Microsoft, Meta, which is Facebook, Instagram, Amazon Web Services, Google, and Apple. So the amount of capital that is expected to be spent in the next 5 years is almost 5 times what it costs to create the 5 biggest, most profitable companies in the world. So an extraordinary amount of money, very different business model to technology historically, which has been reasonably asset light. And then on the bottom right, we've also done some sums that show to justify this expenditure, you need sort of 2 trillion plus in sales from AI companies like ChatGPT by 2030. And we merely point out that that seems improbable to us. So $2.5 trillion is the figure we came up with. Obviously, huge range of possibilities. But $2.5 trillion would be twice the revenues of Microsoft, Meta, Amazon, Google, and Apple combined last year. So expectations absolutely sky high. And I think people are rightfully looking at this level of expenditure and saying, how can this be sustained? And we're certainly wondering about that ourselves. And we think we're sort of healthily skeptical, about that. So we've had and still do have exposure to AI. We think it would have been negligent not to have participated in some of this strength, because this is a new, extraordinary technology that I'm sure will profoundly change the world in the decades to come. But we're looking at our positions in things like Taiwan Semi, and at the margin sort of cutting back and thinking about how to reduce our exposure. One thing I think at Brunner is we don't want to have all our eggs in one basket. We want to have lots of different investments that make their money in different ways. AI has been very lucrative as an investment for us, but now we're thinking perhaps it's time just to rein in our exposure and redeploy that money to elsewhere. So that's been half an hour. So I think, Thomas, I'm not sure what you would like to do now. Perhaps leave it there and move on to any questions that people might have.
Great, thanks very much, Julian. Yeah, we do have a few questions already coming in, but if you're in the audience, we've got plenty of time, so please do add them. On that final point, though, so you mentioned that maybe looking to reinvest some money from AI. Where would you be looking, do you think? I mean, you do own Microsoft, TSMC, so you've still got some exposure to that sector. Are you looking to rotate fully away from AI, or are you looking for other opportunities in that space, but perhaps less expensive?
Yeah, I mean, those stocks, they're not actually, if you look at sort of traditional multiples, they're not egregiously expensive. I think that's the first thing to say. So when people talk about an AI bubble, I think if you look at those, if you look at those sort of mega cap tech companies, that they're not obviously and egregiously expensive. For something like Microsoft is a very diverse company. A lot of its revenues, sort of the software, it's the teams that we use every day, the Excel, PowerPoint, Word, basically the Office suite. And that's great. That's a great business. It's recurring revenues, very steady. So that's slightly different. But it has become involved in AI because it partially owns, OpenAI, ChatGPT, and it hosts AI in its cloud business. So Microsoft's one we'll probably hold on to, but we have been coming back a little bit at the margin. Taiwan Semi is a bit different. So I think, semiconductors have always been cyclical. So, huge booms and then busts. So it's slightly different there. So we've been cutting some back and probably will continue to do so. But we don't want to exit entirely. We still think it's an exceptional business, and we don't want to be too cute about timing cycles. In terms of where we're looking to reinvest, we're sort of going to slightly more humble businesses. So, for example, recently we've been adding to a company called AIA, which is a life and health insurer in Hong Kong. So this is a company that sort of sells basically life insurance, health insurance, low risk products. They're not taking sort of much in the way of interest rate, market risk, or longevity risk, or anything like that. They're structured prudently, but they sell basically into Hong Kong, mainland China, Indonesia, Thailand's a very good business for them, Singapore. So basically they're providing insurance in an area where the social security safety net is quite weak. So basically there's very little public healthcare, for example. So if you want to have sort of health protection, you have to buy a product. And that's a good business. It generates cash. It's growing quite nicely, under-penetrated markets, quite a low multiple. So we've been adding there. It's a bit more humble. We've been building our position in SSE, which is a UK-listed utilities business, which has got a good growth profile, decent dividends. Again, very sort of soberly valued. So we've been sort of slightly pushing in that direction. So away slightly from sort of glamour and growth towards sort of more sort of humble cash cows. And we're also doing some work. We're doing some work in the property sector as well. So property REITs, for example, have been very weak as interest rates have gone up over the last several years. But we think, now with interest rates a bit higher and their interest costs haven't gone up, the earnings look, pretty solid, and you can get some really nice yields for what look like pretty safe, secure businesses.
And how about the healthcare and the biotechnology sectors? Do you have any investments in that area? I think biotechnology is another area that's really been out of favor for a while.
Yes. So our holding there, our main one is called Thermo Fisher, which is a US listed company in life science tools and services. So that is essentially an enabler for biotech companies and other pharma companies and research labs in academia, etc. And they do a very wide range of services. So they will, for example, run a clinical trial for you. They will manufacture complex pharmaceuticals for you. They make what's called bioprocessing consumables. So if you want to manufacture a biological drug, a lot of new drugs are biologicals, they're proteins, and they're not sort of manufactured by mixing together chemicals. They're actually manufactured in cells, and they need feed. They need filters to process, and those consumables are something that Thermo Fisher sells. And that's been in a downturn for a long time after COVID, but it does seem like that industry is now starting to turn. Inventory is being cleared out, and Thermo Fisher, I think, is poised to benefit. And then Thermo Fisher also does some amazing technologies. It does, CRISPR gene editing machines. If you happen to want to buy the world's most powerful electron microscope, Thermo Fisher would make it. Whole sort of raft of things like that. So that's one of our investments. And then we've got a couple of sort of traditional pharma companies. So Roche in Switzerland and GSK in the UK, both of which had got very, very cheap and have done pretty well actually in the last few months. So in the last few months, there's been a bit of a recovery in pharma names as it's become clear that Trump in America isn't going to be too punitive on pharmaceutical pricing. So there was a fear for a while that the US government was effectively going to enforce European-style pharmaceutical procurement, which would not be good for the pharma companies because they make a lot of profit in the States. So those are, I think, our sort of main holdings in that space.
You mentioned looking at REITs and property. Are there any UK REITs you've been purchasing or find interesting?
Yeah, I haven't purchased anything at the moment. We're just doing some work, and yeah, we are slightly skewing towards the UK actually. So one thing you need to consider when you're a sort of global manager and you have an income requirement, actually, any investor should consider this, is the withholding tax on dividends. And withholding taxes vary around the world. And one of the advantages of the UK is that there's no withholding tax on dividends. It's actually quite generous. It's quite unusual globally. So for a trust, we don't pay any tax on a UK listed REIT, whereas we would pay, for example, in America, we would pay 15% tax. And we were looking at some things in Australia as well, where we pay 15% tax as well. So it makes sense for us to skew towards the UK. And we're just looking at some sort of plain vanilla REITs. So and sort of just property owners rather than developers. So there's a couple of names that we're looking at, one of which owns just healthcare properties. The other one actually owns supermarkets, just supermarket buildings that, are leased to like Tesco and Sainsbury's. And they both have sort of 8% sort of dividend yields. And so we haven't made any sort of firm decisions there, but that's the sort of thing that we're looking at. And in sort of classic Brunner style, what we're trying to do is sort of establish which have the stronger balance sheets, which are less exposed to interest rates, which is vital for any property investment. And what we tend to do in any sector like that, where you're probably a bit more reliant upon macro considerations like interest rates, what we tend to do is just try and find the most resilient one. So we're sort of going through that sector, doing our due diligence, trying to find something that combines income with safety effectively. So yeah, spending a lot of time looking at balance sheets, looking for the ones that are less levered and therefore less sensitive to interest rates.
Does the UK ever appear in the higher growth part of your portfolio, or are we just a cash cow?
Cash cow. There's very few high growth businesses listed in the UK. There's quite a lot of those sort of steady growers. Those that core of businesses that provides good cash yields and also grows a bit. So I mean, Auto Trader probably wouldn't describe as a fast grower, but it should grow earnings per share, between 5 and 10%, whilst also delivering a cash return of about 6%. So that's a sort of good growth, algorithm. We have Intercontinental Hotels, which we think is terrific. Again, a company that delivers a good sort of cash yield, very cash generative, but also grows. So Intercontinental Hotels, it's an asset-light hotel business, doesn't actually own hotels, basically lends their brands, so like Intercontinental, Six Senses Resorts, Crowne Plaza. In the States, Holiday Inn is a very big chain. They have a big business in China, the States, all over Europe. And every time anyone wants to develop a new hotel, they will typically license a brand from IHG or one of their competitors like Hilton. And IHG gets a lovely fee stream, which exists for the length of that contract, which is typically 20 or 30 years. So generally, the structural growth in travel, there's more hotels, more people spending time away from home. Hotel prices tend to go up a little bit every year. And so what IHG combine is, good cash return plus growth as they sign new hotels to their network and as hotel prices go up. So it's a lovely business. And that's, a core holding in that sort of steady grower category.
We had a question about UK infrastructure. We were talking about REITs. Are you looking at the infrastructure companies too, or is it like HICL or IMP or?
I don't know those to be honest. Probably an area where I would like to do some more work, but I'm personally not familiar with them. So the only infrastructure company we have is a company called AENA. So it's a Spanish company. It's an acronym, Aeroports, something Español Nacional. So AENA basically own every airport in Spain, freehold. So completely unique assets. Very strong balance sheet, not geared. Owns those assets freehold. So out of all the infrastructure stocks that we've looked at, that was one which we liked best because it had sort of freehold ownership, unique assets, effectively another monopoly position, and thinks of good reasons why sort of structural growth in air travel in Spain. So very tourist dependent economy. Actually, good GDP growth in Spain at the moment as well. So that's the name that we have in the infrastructure space.
And they're butting heads with Mr. O'Leary of Ryanair as well, I think, at the moment, aren't they?
Yeah, he hates them. We had a meeting actually with Mr. O'Leary from Ryanair. It's his job basically just to make sure that he obviously just wants to squeeze every single cost out. I think what he objects to is the landing fees that there are at some provincial Spanish airports, which apparently are the same as they are in Barcelona and Madrid, which is sort of much bigger international airports. But ultimately, AENA can do what they want. He has no alternative. There's no other airports in Spain. I mean, if they were egregiously expensive, what he could do is say, okay, we're going to redeploy our aircraft away from Spain to, I don't know, Greece or Eastern Europe. But I think it's a long way from there. So there's a bit of a dance going on. But ultimately, the landing fees in Spain are set by the government.
Coming up to our time, we do have another question or two. Are you okay to continue a
I
couple
am.
of
Yep.
minutes?
Yep.
We had a couple of questions on performance,
Yep.
and you did discuss a little bit on some of the factors over the past year
Yep.
that have been working.
Mm.
We had a couple of questions on, say, 1 and 3 year performance, and on the discount that has opened up. So just to provide some context, 1 year NAV about 9%, 3 year NAV about 42%. So good in absolute terms, a little behind the global equity index.
Yeah.
So could you perhaps give us a bit of context about that? And then on the discount, I mean, it's not really in your control, but do you have any views on what the board might do to approach that?
Yeah. Yeah. So sure. So over the last year, I think NAV year to date is about 5% behind benchmark. I think largely attributable to those sort of stylistic headwinds we discussed. So we do have this bias to quality. We're not all in on quality, but we do have a bias to quality. We also have an income requirement, and both of those factors have had a tough year. In fact, income has had a very tough 5 years versus the world, simply because tech has dominated the race. So that's sort of I think the bulk of it, and then we've had a couple of stocks that haven't worked out as we would have hoped. And when you run a 50 stock portfolio, that it's inevitable at the end of the year that you have one or two names that you regret having, and there's certainly been that over the last 12 months. But we're in a sort of an industry of sort of marginal gains. Typically if you get 60% of your stocks to outperform, you do well. And I mean, one thing, perhaps actually, if you go to the next slide, Thomas, it's quite helpful as well. Is sorry, it's the next one maybe. I think it's there. No, it's not. Anyway, hold on a second. Oh, I've lost it. But anyway, the average stock has underperformed the index. I think if you go to slide 18, actually, yeah, this one. So on the left, this shows the equal weight S&P. So when you sort of weight every stock in the index the same compared to the S&P 500 as it is, which weights the stock depending on their market cap. So it's just probabilistically been quite a hard market to outperform, unless you've held literally sort of each of the Magnificent Seven sort of thing. We've held some of them, but we haven't held them all because we wanted a bit more diversification. So that's been sort of part of it. So I think that's the sort of explanation, sort of at a sort of headline level. And on the discount, we started the year at a premium, which is quite unusual for any trust. And so, over the course of 2023, 24, we had this exceptional run, really great sort of NAV growth and the premium, the discount going to a premium. And then just over the last few months, the discounts all widened out. So the discounts widened out to about 10%, as you mentioned at the start. Which means now that you get shares in all these wonderful companies for sort of 10% off, basically, when you're buying Brunner. And so the board recently, for the first time in a long time, has initiated a small buyback just to create a little bit of demand. And they seem to sort of do that when it sort of hits 10%. But we've had some meetings, recently where some institutional buyers, some wealth managers, the 10% discount gets people interested and tends to create some buying interest. And certainly in the past, when we've widened to 10%, it's tended to close as people have sort of stepped in to buy. So yeah, it means that shares in Brunner over the last 12 months have lagged a little bit. So a combination of underperformance at the NAV level, which is typical for a company like ours. We're all about sort of resilience, quality, and what that means is you tend not to keep up in a cyclical market, but then you tend to protect better, when there's a downturn or a crash, and would expect that to be the case. Again, although obviously we can't guarantee that. And then, yeah, combine that with the widening of the discount, just means that the shares in Brunner have, over the last 12 months, they've gone up, but not as much as the market.
Great, thank you. Very clear. And thanks very much, Julian, for the presentation, for your answer to all those questions. And thank you to the audience for your interest.
Yes, thank you.
Hopefully that was useful. We should have the slides and the presentation on the website shortly if you want to view it again. And hopefully we'll see you this afternoon, where we will be hearing from Baillie Gifford China Growth. So Julian, thanks very much, and have a great rest of your day.
Thanks, everyone. Bye-bye.